Good evening, everyone. My name is Paul Young, and I'm going to walk you through Canada's competitiveness. This is a key area as we move forward with the economies, just in general, from the provincial level as well as federal level, as we try to create job and economic growth that will drive the middle class. So I'm going to walk you through different things that are going to impact competitiveness in Canada to kind of give you an overview of where we're at and what's going to take to move us forward. So my agenda will talk trade, I'll talk hydro rates, I'll talk labor rates, I'll talk productivity, I'll talk about commodity prices, taxation policies, as well as R&D programs. So trade. Well, Canada basically exports close to $520 billion worth of goods and services. And if you measure that in terms of the overall GDP growth, it's about one quarter of all GDP. Now that's a very significant amount of dollars. So Canada's economy itself depends on exports to drive it, because we're only a population of about 36 million people. We need to be able to export goods and services outside this country. So it's very important that we sign trade deals that allow unfettered access to global marketplace. This is why you're seeing things like the FIPA agreement, which they signed with China, as well as originally the TPP one, which is the Trans-Pacific agreements. So basically what I wanted to show you here is just the different free trade agreements that have been signed, or investment agreements. Now, there's always a misnomer when you listen to people talk, when you hear Jim Stanford talk or people talk about trade. They don't truly grasp what it is it takes to compete in a globalized marketplace. It's not easy for you to go as a company to just go into China or India. You have to basically work with the governments and follow their rules in terms of setting up operations there. So it's very important to have government backing in terms of policies, in terms of trade agreements, as well as protection built into your accounts receivable side. And I would encourage you to go out to the government's website or go to EDC to kind of see a little bit more about the trade and investment opportunities and how it can better your company itself as you're moving to global, expand your products and services. Basically, all I wanted to do is basically looking at the EDC. This is just basically a quick scorecard and summary, what you're seeing in terms of the volume, in terms of the job creation. And basically, it's almost a $600,000 jobs related to exports. Now, here's the ticket to remember. For each $1 billion of exports, it creates about 5,500 jobs. So if we were to expand exports by 25%, then it would actually increase our jobs by close to $500,000 jobs. And typically, export jobs pay higher salaries. That's never discussed by opposition parties or even the provincial government in terms of the magnitude of what exports do in terms of drive the economy. Now I pulled up two particular comments. These guys are Ralph Goodale is he was a critic on basically talking about foreign trade imbalances, but basically he talks at a high level, but he doesn't talk about what drives trade imbalances. We can export goods all we want, but we need to make sure that we've got fair trade deals going into play. So if we've got a trade deficits of 25-30 billion, that means we're importing more than we're exporting. It's very easy for the government officials like Goodale to call that out, but the reality is, unless we find better ways to expand our exports into new markets, and that means getting into India and China, or upselling opportunities in products like food services, forestry, or different things that we have a competitive advantage, then it's very difficult to close down that imbalance. It's nice to talk at an overall level, but it isn't unless you go into the specific details. This one just shows you where trade is. The big three trading partners are United States, Europe, and China. Now let's talk about global economic growth there. So as a company, I'm trying to expand out. Well, China is only growing at 6%. Europe on average may be growing at 1.5% to 2%. US is growing at 2.5% to 3%. Now, US has struggled for a good chunk of the last 10 years to get economic growth up. So if you've got struggles with key markets where 75-80% of your goods and services are going, then you're going to struggle to expand exports. So that's why it's so important to look at trade deals with other countries that are growing. And that's why TPP came into play. We're going into the South Asia market, which is a growing market. It's very strong potential for companies to expand opportunities in there to help businesses grow. And that impacts productivity. It also impacts the overall bottom line of companies. This just looks at imports. Again, just to kind of give you a good example of it. I wanted to pay attention to trade imbalances. So Right away you see the biggest trade imbalances are with the EU, China, Mexico, and other countries. Now China is a big issue because of the finished goods that are manufactured in. So it's very important to understand basically what's going on. And that's why I basically want to illustrate that in order to close that down, we have to look at upselling opportunities. And the only way you do that is through trade agreements and companies expanding their business opportunities within those jurisdictions to reduce the imports down. What does Canada export? Well, I highlighted most of what this is, took you up to June. And if you look at basically what we export, oil, energy products is the big one. But if you look at metallic metals, that's another big one. But what's interesting there is if you look at down consumer goods, we actually export consumer goods, and motor vehicle parts are significantly. So that's key to understand that, so that when you're looking at the overall productivity and the costing, we need to make sure that we're competitive in those market segments as part of expanding export opportunities. This just kind of gives you an idea of imports. And now this just shows you the imbalance in terms of where the main areas are in terms of where we need to correct. And you look at the industrial machinery, motor vehicle parts, and consumer goods. Now, as I said before, if you're going to basically support an economy and competitiveness, then you need to have fair deals. You need to look at advanced manufacturing, green technology, forestry areas where Canada has a competitive advantage that they can able to export out or expand on that. We also need to continually look at policies that will drive natural resource extraction and refining. Okay, that's where you're seeing the lithium, nickel, vanadium, oil, natural gas. The biggest problem with resource natural extraction now is we've got governments at a provincial level and a federal level that are becoming more socialist and seem to be thinking that they want to put more policies in that's going to impact extraction. And that's really critical to understand that, because without a strong economy, you don't have tax dollars. If you don't have tax dollars, you don't have money going back into the system through social programs. I got internal trade barriers here. We need to be able to have freer movement of goods and services. That's another problem. I've got port and pipeline capacity. We need to be able to move goods outside. Right now, as I mentioned earlier in the presentation, that exports are likely 25 cents below because we don't have the capacity, either the manufacturing extraction or the infrastructure to move goods out. Let's talk power generation. Now this is a big area. If you look at the costs of goods sold for a company, their power rates, labor rates are the big two. Then you get in raw materials and then overhead. I'm going to focus on power rates because what's happening is, if you look at this particular power generation, okay, we're only generating a small portion of green energy. Yet it's more costly to bring in wind and solar compared to hydro or nuclear power in general, because of what's required. That's forcing cost up on the hydro, which is causing competitiveness issues on the hydro rates, and that's what I'm going to get into discussing now. So if you look at here, this just gives you a good chart in terms of labor rates for customers across. Most cases, a southern tier in states like Kentucky got pretty much good control of their hydro rates to allow them that competitive advantage over Ontario. That's why you're seeing states like Kentucky growing, because they've got the competitive place from marketplace in terms of their labor rates as well as their hydro rates to be able to leverage that to make them attractive to business. I wanted to show you the benchmarking rates here so you can see where Ontario is compared to other provinces and other jurisdictions. And you're looking at Pennsylvania, you're looking at Texas. Most cases, Ontario's hydro rates are double that to other jurisdictions. So our business is already behind the 8 ball when it's trying to compete with other jurisdictions for foreign direct investment or to expand exports to keep cost controls. This is not something that Charles de Souza or Kathleen Wynne talk about, but it's a significant issue facing business. And if we don't attract business, we don't attract good paying jobs. If we don't attract good paying jobs, then we're going to have stagnation between wages and opportunities for kids coming out of school to get that first good job. And that's critical here. Let's talk about R&D. Okay, Canada's actually improved on R&D. We're still not doing significantly enough in terms of taking ideas from incubation to market. There's some programs I'll get into to discuss to kind of help foster that stuff, but there's still significant issues. This shows you kind of where a lot of this stuff is. A lot of the investment in Canada's case, where the big R&D spenders are typically technology, and they're typically biotech, pharmaceutical, but you're seeing Magnum on there because they're still looking at automotive parts and production. Now, this kind of gives you an example of some of the funds. The SDTC is a renewable energy fund. Then there's also multiple funds in terms of aerospace, advanced manufacturing, automotive, that can be leveraged as part of helping support ideas from incubation to market. Again, this shows you some of the areas where the ranking is, as well as some of the other programs in play. Let's talk productivity now. Productivity basically is looking at how we move things, how productive are we in terms of producing a goods, in terms of the overall manufacturing process. In the 90s, we were pretty good, we had improved in productivity, but the gap between us and the US is widened. And there's a lot of factors going into play. A lot of that has to do with the lack of capital investment that's been brought into the country. There's a lot of issues with infrastructure in terms of roads and port development. Now, it's easy to blame Harper or the federal government, but some of the provinces put less focus on supporting business in terms of productivity issues. This kind of shows you some of the funds in terms of infrastructure. The key thing with infrastructure, it should drive GDP growth as part of one of the assessments of where you're putting investments. That's critical. It's not the same municipalities shouldn't be building water and wastewater treatment, but there has to be the right mix to ensure that you are supporting the GDP growth. Let's talk tax competitiveness. This is another area. Canada's corporate tax rates are pretty competitive. Some of our R&D programs are pretty competitive. So you're seeing here, Canada is still ranked in the top 10 in the world, number one in terms of tax competitive. Now that's likely to change when I go into the subsequent slides to kind of show you and demonstrate. Here's the reason why. Across Canada, we brought in different governments who decided to basically bring in bad after bad policies, whether that's a royalty review that impacts the oil and gas sector, whether that's provincial corporate tax increases, whether that's Ontario Registered Pension Plan, whether that's carbon pricing taxation. All these things do not help the competitiveness for a company. They actually add more cost. When you add more cost to business, that impacts the bottom line. That bottom line impacts where these companies want to invest. If they feel they're being taxed more out of it, taxed out in the marketplace, they'll go elsewhere to make their choice in terms of foreign direct investment. Let's talk labor costs. Well, if you look at Canada's case in labor cost, okay, now if you look at us, we're ranked 7, okay, so if you see there, Mexico's ranked 3. Now, most cases, a lot of organizations have gotten brought in a lot more automation, so we're able to leverage some of that. But when you add in higher hydro costs, you add in issues with productivity, you add in more taxation policies, what you've done is you've handcuffed Canada's ability to compete fairly with other jurisdictions that are looking at ways to attract business. Attracting business is very competitive. You could put a smile on your face like Kathleen Wynne likes to do. The reality is they're not going to invest here if they don't think they can get a better return for their investment. And that's the key aspect of when you're going to drive in terms of talking about competitiveness. I just want to show you commodity prices because Canada is driven by this. This impacts raw material cost. And that's why I wanted to show you here this particular graph where you've seen where commodity prices like oil and that are half of what that is. That also impacts our imports. So if we're importing raw materials from other countries, that'll impact our costs, especially with the US dollars on conversion. Let's talk about capital investment. Okay. Now, most cases, the biggest chunk of capital investment has been the oil sands area, and that's where we're getting a lot of foreign direct investment to do that. Canada cannot generate enough capital from its banking sector to support the capital required to extract or manufacture things here. So we rely on foreign direct investment, plus we're a branch plant or a branch economy where we have a lot of subsidiaries of foreign parents. That's something that's never discussed by Goodale or any sort of government policy or anybody else from Unifor or other unions led by Jim Stanford. They don't really discuss that. They discuss the idea of they believe government hasn't done enough, but yet they don't go into factors which would drive this. And I just want to show you that here in terms of the policies. Foreign direct investment. Canada's ranked, has got a significant amount of investment come in. But we're not key jurisdictions anymore where that money's going. If you look at now, you're seeing now, basically, you're seeing countries like China. You're seeing other countries like Mexico pick up the investment now. Why is that? Because their competitiveness position is a lot better. And yet you never hear about that discussion. Let's talk about government policies. During the election, Jason Myers of the Canadian Manufacturers Association has said Stephen Harper in general supported manufacturing with the proper policies. But he was handcuffed when you have governments like Kathleen Wynne that bring in bad after bad policy from hydro rates to just poor management of their budget cycle. Because the last thing businesses want to see as a province is a basket case, because that means future taxes and it will impact them down the road with their bottom line. But that's never discussed by anybody, because the unions never talk about that, because as long as they get the government in charge they want, they get their policies. That's what it's about. This is just giving you key driver rates just so you guys can have this information in terms of what drives it. And I brought this up during the election in terms of things, in terms of the manufacturing cost, and just in terms of overall policy from taxation to R&D innovation. I want to just bring in manufacturing here, so it just gives you an idea, where basically, since we've lost a lot of capacity in transportation sector, other industries, metal fabrication, the loss of oil has never been able to offset from other sectors, and that's a capacity issue. That's not something that's been discussed properly from provincial governments, because it's easy to blame the federal government on it, but in essence, the provincial policies are kind of driving investment out. Let's talk about supply chain management now. I just want to go quickly through this, and more so I want to spend some time in terms of what's driving this, because this is all part of competitiveness. We're talking about how operations are becoming more and more connected with technology, more and more the ability to be adaptable or agile in terms of trends. That's what you're seeing here with social analytics and just the idea of managing data. Also too, because of the nature of the pressure on organizations in terms of the carbon footprint, they basically want to make sure that they've integrated with all their operations to understand the carbon footprint and what they can do to mitigate some of those risks. I brought in e-commerce here because this is going to drive the end stage when we manufacture goods and how we're producing and get it to the end market. And just the whole idea how the supply chain now is becoming different with the hub and spoke approach, which actually impacts overall productivity, because that's impacting how quickly we get goods and services to market. Let's talk nearshoring. In the 90s, it was a big push for companies, multinationals, to push things to low-cost producing markets. That was a big thing in the 90s. That's where China grew up overnight in terms of it being a manufactured powerhouse. What's happening now, companies are revisiting it. They need to be closer to their customer base. So there's a big potential to move more and more jobs back to North America. But in order to do that for Canada, it has to be competitive. And we seem to be losing our competitiveness because between labor rates, hydro rates, and logistics, we seem to be behind the 8 ball, because any government coming in now doesn't seem to grasp that we need to be competitive on how we operate here. Now for labor rates right now and some of this stuff, we're going to be masked a little bit, distorted because of the low Canadian dollar, but that's only a blip up. We need to get our policies in place to make sure that we align our labor rates, our hydro rates, and just the overall cost to do business, then it makes sense that we move forward. And that's something that's not discussed properly in terms of a policy review. When you hear the new finance minister talk about things, he doesn't talk about policies in terms of what's required. He's asking for ideas. And what bothers me there, they're trying to reinvent the wheel when you don't really need to do that. What you need to do is take a step back on your policies and make sure that you have bring in the right mix of policies that support taxation but also support job creation. And that's the thing that I don't understand when we start electing socialist type of governments. They seem to not grasp that without a strong economy, you don't have the tax dollars. I just want to bring in collaborative. This is basically getting everybody involved in the supply chain to make sure that we align with better integration of operations. I did this presentation to run through competitiveness because I'm getting frustrated with the conversations going back and forth and hearing people blame different people as part of the solution. The solution is very simple. You need to start getting a government that understands policy and understands how complex supply chain management and how you have to respond in terms of policy to support it. This is very critical as we move forward as a country. If we're going to attract good paying jobs through foreign direct investment, then we need to make sure that we have the right balance of policies. Thank you.